Hello and welcome to the Financial Time Travelers podcast. This is episode 7, 3 reasons to buy real estate now.
You better hurry.
Get it in.
Even a pink house.
I wouldn't buy a pink house. Although you can repaint it, so it's no big deal.
Yeah, you can paint.
All right. Let me turn that down a little bit.
Wow.
A little flash in the headphones. Turn me up. 1, 2, 1, 2.
Do we know what we're doing here?
We have no idea.
Okay. I
Today
can't
we're
wait.
talking about toys. No. Today we're talking about building wealth.
Yes.
Like we always do. How to achieve your goals at a faster rate. We are very excited about this topic. Might be one of the most important topics that we all understand as a society. Because
Another one that's
It's all very important.
Okay.
Because this is one of the, I'm like out of breath.
Yeah.
It's one of the great ways for us to be able to build wealth, especially the environment that we're in right now. What are we talking about, Anton?
So part of this podcast, and actually part of our whole theme of what we're trying to do and trying to pass on, is that building wealth, there are times that you can be very proactive, take a lot of time. At night, you're working, studying your investment portfolios, your 401k. It takes work.
Right.
But there are other ways to build wealth that doesn't take any work at all.
Mm-hmm.
And that's what we're going to cover about today, is that there are things that you are doing right now that could be costing you money, or it could be building your wealth. But let's talk about the environment right now.
The environment that we're in to buy what? You haven't talked about it.
Buying a home.
Buying a home. That's what it is. I think we confuse people when we don't tell them what we're talking about.
Yeah, what to buy.
So let's say
so last week, there's some statistics that came out last week that are going to lay the foundation of why this is so important. Because some of this information...
I like what you did there.
What's that?
Was that a pun? Lay the foundation? I see you.
Lay the foundation.
And lay the groundwork.
And we want to rebar it, yes. And bracket it in. So the Bureau of Labor Statistics last week came out with their JOLTS, which is the Jobs and Openings and Labor Turnover Survey. And what they do is they monitor in this report, I read through the report, how many new jobs were created, how many jobs were terminated, how many people left voluntarily, how many people were terminated. It goes through all the different aspects.
Probably one of our favorite labor reports because it's the most detailed.
And thorough.
And it's a little bit more of a lagging indicator because it goes through previous quarter or month data.
Right. This is ending June 31st for the month of July, and so this is very interesting information. 5.6 million new job openings were established in July from June, so a very little change there. That's a very good pace, by the way, and more importantly, that layoffs and discharge. So those are involuntary terminations. You know, they came to you and said, Joe, we really like you, but we
don't really like you that much.
We don't like you that much. But
we like you as a person, just not as an employee.
Yeah, we love you, but we don't want to pay you.
Will you stay on the softball team?
Yeah. That's like that movie, what was it, Office, where they kept moving him down and not paying him.
Oh, the stapler.
Yeah, the stapler. So anyway, layoffs and involuntary discharges remained at 1.1%, which is the lowest rate since 2001. So that's a 15-year low.
That's significant.
Yes. So we have 5.6 million new jobs that are being created, job openings, and we have the lowest rate of layoffs and involuntary discharges since 2001.
Okay.
So the Bureau in this report, I pulled a quote out now that I wanted to read. It said over the 12 months ending in June, hires totaled 62.3 million jobs, and separations totaled 59.8 million. So you have a net gain of jobs of 2.5 million. And these totals include workers who may have been hired and separated more than once during the last year. So, and unemployment, which most people don't know this, but there are 6 categories of the unemployment report. The one that most people are familiar with is the U3 unemployment report.
Only 4 of those are politically correct.
Yeah. And so of the U3 unemployment everybody hears about, that dropped below 5%. So since 2010, the bottom of the Great Recession that started in 2006, we are now nearly back to where we were at pre-recession levels. And job growth, we have unemployment below 5%. And so what we have is an environment that is in an employable situation. Now, granted, there's more behind this data, and that's how much people are working. So we've got that. But what we don't know, or what we do know, what's not being brought out here is how much are they making.
And while we're establishing this first talking point, which
Yes.
is that people are working more
And the economy,
now,
there are
there are
people
more
working.
jobs.
Yeah, not necessarily making more money, but they are working. Oh, you got something?
I got something to talk about who is making more overall wage increases in key industries since February 2010.
Okay.
We're seeing the most in financials, and then education and healthcare is up.
Okay. Do we have numbers or just...
Well, education and healthcare is almost up 10%.
Okay.
Truck transportation is up similar amount, a little bit more.
Yeah, until they have driverless
information
trucks.
is up 15% plus.
Information technology.
Just information.
Okay.
Specialized design is up 20%.
Mm-hmm.
What's down overall? Goods, mining, construction, manufacturing.
Right. Right.
So there are certain areas that are making
Right.
more and other areas that are making less.
Right.
And
So
there's a
clearly-
great rotation that's happening in society. And right now we
Right.
have lower interest rates that you said. It helps companies kind of make certain decisions, as well as we
Leverage.
have technologies that are helping inefficiencies or
Right.
efficiencies that are
Right.
kind of getting in the way. Now, transportation kind of jumps out at me, truck transportation, because I think that, and we'll cover that in a future podcast with autonomous driving, that's going to get hit pretty hard.
Yeah, we're going to talk about driverless
but
cars,
some people-
driverless society.
Some people are
Right.
making more money. Our unemployment rate is lower than
Right.
it has been since
Right.
pre-recessionary levels. And then there are new job openings, as
Right.
you just covered. So
Yep.
on the jobs section of this podcast, we are in good health
Yep.
as a country overall.
So that's the foundation we're laying here, is that we have a trifecta of some very good dynamics here. We have an employable nation. We have unemployment below 5%. We have 62 million new jobs being created, 62.3 million new jobs. We have, number two, a very low interest rate. The mortgage rates for houses have dropped below 4% now.
Right.
When it was at 4.5% 2 years ago, I said this is the lowest rate we're going to see the rest of our lifetime.
Still going.
And it's now at 3.5%, in some cases 3.25%. So number two is we have a very low interest rate market. And then number three is we have a very low inflationary market. For most goods and services, we are not seeing a very large growth in goods and service prices. So we have a low interest rate, low inflation rate, and we have people working. So the point here is that we've got a very accommodating economy that would think that we'd have the highest home ownership in America.
Right. Another quote or another stat to cite is
All right.
that household net worth is now $20 trillion above its pre-Great Recession high.
What is that number again?
$20 trillion above.
Right.
So household net worth in Q1 of this year was a record $88 trillion, as opposed to the pre-recession peak previously, which was at $67 trillion.
Yeah.
And so it took a nice dip. It was on the run going up into 2007, went down. It bottomed at the recession in the middle of 2008, and it's been on a steady increase since then. So people are making more money on a household average.
Right. Now there's some circling back that needs to be done here, and we won't go too deep into it, but our federal debt is crossed $20 trillion. So the federal debt for the first time has crossed 100% of total net worth of Americans. And in 1965, it was 30%.
That's a good
So
quote
so
there.
a lot. So the question is where did the wealth come from? And you know, a listener, an astute listener listening to this would say, okay, everyone's working. How come the economy's not growing? Well, the people are working. Net worths are at 20 trillion, but our debt is at 20 trillion.
We're going to have to do a future podcast on the unprecedented government and stimulus intervention.
Where does the money come from?
How is that? What's the fixed income market? How is that going to affect the bottom line of the average American? Where does it start? I would love to do a podcast and really break down the basics of where the money comes out of the Fed, where does it go, and really follow the money all the way to the end user.
Yeah.
If it even gets there.
That's right.
Most times
so that's called velocity of money and the source of money. So when money is created, then it starts moving through the economy, not only in the U.S., but around the world. It's a very fascinating study to monitor where the money is and where the money is going and follow the money. And that's where investors, that's where they look at the gaps and that's where they put their money because they want to fill that gap and be there. But anyway, so back to our topic today is houses. And why in such a good environment are less people owning homes today than they have since 1965, a report that came out recently by the National Association of Realtors that home ownership in 178 major real estate markets. So listen to this, 178 major real estate markets in the United States.
Metropolis areas.
Right, 1 million people or more. 83% of them had housing price increases in the last quarter. And currently, mortgage rates are at 60-year lows.
Right.
So now you would think, wow, knowing this information, not only do I have my job, not only are interest rates low, not only is inflation low, but house prices are going up. And they're going up in almost all major metropolitan areas. But yet at the same time, we have this statistics from the Bureau that 62.9% of home ownership is the 50-year low of this country.
62.9%, 51-year low.
Right. Big numbers
of
here.
Home ownership. So we have homes going up.
So why is this?
We have low interest rates. We have people working. We have home net worth going up. We're in a perfect storm for you to be able, or in the eye of the storm, I guess, for you to be able to buy a home.
Right.
Why are we not seeing those numbers go up? I think that there's another great piece to supplement this, which is the supply and demand.
Right. We're going to get to that.
We have an over demand and an under supply. We're going to get to it right now. So why don't you speak on that?
So we have 3 reasons, today's topic, 3 reasons why to buy a home now. And the first reason is that it's of the few investment classes, it's one of the few that you can't live without. You can live without stocks. You can live without gold. You can live without a lot of assets in your life, but you can't live without a home. Everybody wants a place to live.
You can,
up until,
but they call that homelessness.
Yeah. Or, in Hawaii, there's lots
camping.
of people. Or camping.
They call it camping.
Yeah, they call it camping, right. But if you want to have a place to put your Christmas tree, if you want a place to be out of the rain, you need a house. And so what's happening is that we, as you had mentioned, Niall, we have the fewest supply of homes available going back to the 1960s. Barron's wrote an article about this, and so did Forbes. We talked about it and have written about it, that we have the fewest number of new homes coming online. So developers are struggling to get land approved. You have environmental issues and factors that are limiting the ability to buy land and develop. You have the difficulty of financing. These are things that our other investment company, our developing company we have, so we're experiencing it as well. And so it's very hard to say, okay, let's get 10 million new homes on the market next year. That's not an easy thing to do. On average is about 700,000 new homes a year are coming online. So it's a very slow process. In fact, it's 200 to 300,000 fewer homes than families being created a year are new homes being built.
Right.
So we have a shrinking supply to
overall,
a growing
and we're
demand.
talking about macro. The thing about real estate that is entirely unique from the stock market is that every single metropolis area is different from each other. So they're all going to have different values. What happens in San Francisco does not affect the value of what happens in Memphis, Tennessee. And so being able to identify what's happening in your particular area that you would like to buy in is a very important aspect, especially if you're talking about where you want to live.
Right.
If you're going to buy a home for an investment versus buying a home to have as your residence, that might be 2 different check marks and criteria that you're looking for as you're on the hunt for that home. I know for me, if I'm looking for an investment, I am very...
you have a different set of parameters.
I'm agnostic to it. Doesn't matter. I don't care about certain things. I just want to make sure that I get the most bang for my buck.
Right.
And I'm hitting the balance sheet and looking at my income statement on my assets and liabilities of this home, pros and cons, basically.
Right.
As opposed to where I live, I'm going to want to.
You're going to knock on doors and meet your future neighbors.
Exactly.
Right. In your house that you bought, I mean, you wanted to be in a quieter traffic area. You want to be on a cul-de-sac.
Right.
You brought up a very good point that it's very local based. It's not just cities. It's this street.
Right.
2 blocks away, that same home could be 3-5% cheaper.
With the same floor plan. I mean, these
exactly
could be cookie cutter homes.
Yeah.
And this house has black mold. That house doesn't. The exact same floor plan, but you're getting comp prices.
Right.
On the
even
exact
if it's
same.
Even if it's structurally sound,
Each one's different.
The 10 neighbors around your home, they don't cut the lawn.
The road noise might be different.
Yeah, just 2-3 blocks away.
Right.
So housing has some of the insulated components of being a good investment, because New York could be on fire and Omaha could be selling off terribly. You were reading just now about Vancouver. The big and Vancouver, I golfed with a real estate agent that was from Vancouver when I was in Hawaii, and he was telling me 2 years ago, it's on fire. It's just amazing how
Sounds
fast.
Like the beginning to a joke.
Right. I was in Hawaii one day.
I was in Hawaii with a real estate agent from Vancouver.
Yeah. And yeah. And so you were talking about how it's now, what was that? 2 homes have sold in the last month and a half
Vancouver.
in West Vancouver.
There's a huge ramp up in price in Vancouver.
Right.
And of course, everything goes in cycles. So you're going to see some people ease off the gas, especially when you have foreign money that's coming in. Vancouver's a little bit different because they have a lot of foreign overseas money, particularly coming from China, that's just buying up everything that they can get their hands on.
Yeah. So back to our number one reason, though, it is, with all this said, and there is
you got to live somewhere.
You got to live somewhere, and there's no panacea. There's no absolute single asset or investment that's going to solve all your problems. But what I find, or what we find very curious here, is that in a reasonably good economy, after 7 years of reaching a bottom, that we have the fewest home ownership in 51 years.
Which is odd.
Yeah. And so that's very curious why that is the case. And candidly, we know that the biggest factor is the fewest first-time home buyers that we're experiencing in the last 20 to 30 years. And first-time home buyers tend to be younger families, 20 and 30-year-olds. So we're seeing that the millennials are not embracing buying a home.
Right, and we're not building new homes at the rate that we need to, based off of just going off of the data of the amount of new families that are being created every year.
Right.
Just to get off track a little bit, and we won't go down this rabbit hole a lot.
Too deep.
But if we're not building enough new homes for new families, that means they're moving into previously existing homes.
Yeah, used
now,
homes.
These homes are going to want to be updated. Yeah, pre-owned, certified pre-owned.
Yeah, right.
We're joking, Nick and I were joking the other day about what's the difference between pre-owned and used. You go to a dealership, I want a certified pre-owned vehicle. You mean used? No. It's certified pre-owned.
Yeah.
You mean used.
Yeah, we'll call up your real estate agent and say, I'm looking for a used house.
I'm looking for a pre-owned home.
Yeah.
But what I'm getting at is maybe looking at, if you're also in the stock market, which we hope you are, because it's a lot lower bar of entry to get into the stock market.
And it's a great area to
invest. What
about
buying into, when I look at this data, would this be something that I would think about if I'm going to buy Home Depot stock or I'm going to buy Lowe's stock? Because those are two big box stores that sell renovation, home improvement items.
Yep.
If we have a surplus of homes, or a lack of homes, actually, is that something that you would want to look at as an investor for a long-term investment? If we know that we don't have enough new homes, so they have to renovate the old homes, where are they going to buy their stuff from?
We're going to post on this, and we'll show you a picture of the stock of Home Depot in the last 5 years, and it looks like a rocket ship.
Yep.
Straight up. And Home Depot, you bring up a very good point, that there are ways, and this is a good point you're bringing up, there are ways to participate in the housing market
without actually owning a home.
You're listening to Anton and Niall, and you go, well, great, I don't have $30,000, $40,000. And it's even less in a lot of places, 5% down. But
especially if you're a first-time home buyer.
Right. It's a struggle. And you know, one side note.
There's amazing first-time home buyer programs. I mean, you only need like 3% down in California.
Yeah. And some 0% down.
Yeah.
What happens is that you have a higher monthly payment,
you
but
get the property,
nonetheless,
mortgage insurance.
But let's say you are listening and you say, you know what, I'm just getting started. I don't have the down payment.
Right.
Like you said, Niall, you can look at companies that benefit from the housing market. You can buy builder stocks.
Right.
So and Home Depot,
ETFs,
right? And
REITs.
look at REITs, and so these are things that we can talk about also. But back to buying your own home and looking at it. Number one, it's an asset class that people will need. They're going to be knocking on your door, and I've had this happen where they knock on the door and say, "Hey, are you thinking about moving?" And so that's going to be more of a factor. So number one, it's an asset class that you own, that you're living in, you're benefiting from it. If you have a stock, you're not personally
live in it.
Right. You're not painting that stock.
Yeah.
You're not putting it up on the wall and saying decorating. You're not even getting the benefit of looking at it.
Yeah.
So you're living in it, and you can improve that home. By just living in that home, you can put in the new front yard. You can paint the rooms.
Pretty much everywhere I go, I improve it. So,
Right.
I mean, why not do that to my home?
Right. So number one. Number two is that it's an asset that will appreciate. Historically, going back to the 1800s,
Right.
it has been an asset class that continually appreciates in value. In the last 13 recessions, Barron's reported about this, the best performing
15 of the 16
15 of the 16 recessions, single-family homes. Now, when we talk about real estate, in this segment, we're only talking about single-family homes. We're not talking about townhouses, duplexes, multi-units, commercial.
What's the initialism for that?
So, single-family home, right? So that's an initial, not an acronym.
Not an acronym.
Not an acronym.
Because it's not a word.
We were schooled on that in our last podcast.
It's a word that goes.
Yeah. So of single-family homes as an asset class in 15 of the last 16 recessions, going back to 1965, it has been the best performing asset class over bonds, which is the number 2 best performing asset class. So it has been...
one exception being the anomalous event that happened with the housing crisis in 2008.
5 to 10, right.
Which, if you look back over those 16 recessions, that's the only time that the housing market has been affected by the stock market in direct correlation because of what was happening with the derivative portfolios.
That's right.
But that's a very anomalous time. In all the other recessionary periods, owning a home was your best hedge.
Right.
Or not even owning your home, owning real estate.
Right. And there are times definitely that are better to buy than not. I mean, you bought after the crash. Anyone that bought anything after 2010 in these last 6 years has killed it. Right.
And I think having that contrarian view of everybody was buying, let's say, 2006, 2005, and then 2011, and you don't want to go with the rhythm where everybody's like, it's so hot, like buying in Vancouver, for instance, when it's popped up 20% and everybody's on that euphoric high. We've talked about cycles. We've talked about how it messes with your emotions.
Right.
That when things are going great, the wealth effect that we covered on our previous episode, you feel wealthier, you want to invest. You really need to be smart.
Right.
And now is a great time to be smart because everybody's being protective, conservative. The market has been up and down all year. We've had these great drop-offs with the Fed flirting with doing some major movements, with Brexit, with the European Union, with different parts of the world going through economic recessionary periods. And right now, everybody's kind of holding their cards close to the table. But I think now's the time to jump, and you're making a great case for real estate, especially in this volatile market that is clearly in an expansion-contraction cycle.
Yeah, and we talked about earlier, there's ways to build wealth, and some ways will require more of your personal attention.
Right.
This one, at the end of the day, you're going home to your asset.
Right.
And you're having dinner. And
there's a joke in there somewhere.
Yeah, somehow. But so that's it. And by the way, the new home construction levels that are now at 51-year lows, that was tracked by the Census Bureau going back to 1965. So this is very significant levels of low construction level, new home construction, very significant low levels of home ownership, and then interest mortgage rates going back to 1960s. So these are very, very long-term statistics that we're now hitting all-time lows.
So what we're getting at, the second point,
which is wealth appreciation.
Right, wealth appreciation, and people aren't buying homes.
Right.
Right, that was a part of our second.
Right, and
number 2 reason.
Yeah, number 2.
Correct me if I'm wrong. I apologize.
And it's a way to build wealth.
Right.
So number 1 is that you can't live without this asset. Number 2, it's an asset that has consistently appreciated, and we saw that 83% of 178 metropolitan cities had appreciation last quarter. But also, it's a way that continues to grow and appreciate. So as we have the common classic scenario of a good investment, a rising demand with a shrinking supply, that's what you want to be in.
Absolutely.
And that is a very classic situation.
A clear-cut scenario.
It's a no-brainer to me.
Yeah.
So now we're going to kind of switch gears and go to somewhat as a point number 3 is going to be a negative approach to a positive, and that is that housing to me.
Hold on, say that again. A negative approach to a positive.
Yeah, a negative approach to a positive is that the housing market is sort of
depressing.
Is sort of like a big river.
Okay,
and
I'm following you.
And so if you own a home, it's like owning a canoe. You're just sitting in the canoe and you're flowing with the river.
Okay.
So if houses price go up, you came home tonight. You didn't do anything, but it slowly appreciated. You have your day, you have your job, you have everything you're worried about and working on, but your house, and you're sitting in that canoe. You're just floating down the river. You're not even paddling.
Right.
All you're doing is just floating with the river. That's like owning a home. If you don't own a home and you're renting, it's like standing in that river. The water's flowing past you. You're watching canoes go past you. In a couple of weeks, you won't even be able to see those canoes that went past you. And that market is continuing to grow while you're standing still.
And you want to build passive income for retirement. I mean, you're building up your 401k to be able to take distributions.
Right.
But it would also be nice that when you turn, whatever magic number your retirement is, that you no longer have to make a mortgage payment.
Right.
Or no longer have to bank a rent payment.
Right.
Because the renters, they might be paying this, less than your mortgage.
Right.
But at the end of the day, you own your home and stop paying, and they don't own anything and keep paying.
Yeah. So this is my concern, is that for the first time, there will be a potential that there will be people that will pay rent their entire life.
For the rest of their life.
Right.
Absolutely.
And I've only met a few people in my lifetime that were in their 50s and 60s and have been renting the whole time. That was an anomaly. I rarely would ever come across that.
And it probably wasn't by choice.
No, these people by choice.
Did they move around a lot?
No,
or?
they just just didn't want to own. It was bizarre. But anyways, it was my parents' friends.
Okay.
And we all couldn't figure it out. But they were perfectly happy, and I'll tell you one thing.
Hey,
the landowner was very happy.
Right.
They didn't move for 40 years.
Wow.
Yeah.
And you just paid off my mortgage.
Thank
and now
you.
everything for the rest once you paid off my 30-year mortgage, and you're still there, that next 10 years is all profit, baby.
So kids born, went to school, went to college, they retired, rented the entire time.
Wow.
Right.
And I wonder how many times they had to come in and tear the carpet out. Not many.
Yeah.
It's the same tenant.
Yeah.
As opposed to you have a turnover every 2 years. You're constantly having to touch that, make it all pretty to attract a new renter.
Right. And we're going to have a very fun conversation about building a real estate portfolio. First step is getting your first home. And the reason why we're talking about this, Niall, is because we would think this is very obvious, but these statistics are indicating that the preponderance of people are choosing not to buy a home.
And when we unwrap kind of the concept of the financial time traveler or financial time travel, it's not to be sitting on the sidelines and be passive and passively invest in kind of that roundabout method of having patience today for rapid impatience at a future date. But when we see ripe time slices, we see the stars align and create this amazing environment that we say, okay, we've been patient, we've waited for the scenario to present itself, and now we're going to go and buy houses up because it's the right time. And I know for you in Harris Bay Real Estate Investments have been taking advantage of this ripe time slice in American history where it is an amazing time to invest in real estate, more so than the stock market. Fair enough. For now, this is the time slice. There might be another time where, like what happened with, the major indices in the 90s. That was a great time to trade options, for instance.
A great time just to buy and own.
Just to buy and hold.
And
so this is one of those ripe time slices where you have been patient, waiting on the sidelines, waiting for that moment to get in and hit the trigger and really make some big bucks because you waited for the right time. And that's what makes your investments move at a faster rate and achieving those goals at a faster rate instead of being impatient, buying at a time where maybe the interest rate was higher
Right.
You could also, if you own your home now, something that we didn't talk about, now that we've covered the 3 points,
right,
is that maybe now's the time to refinance.
Right. Absolutely.
And you wrote an amazing blog post about that.
Right. Yeah. When we're at 3.5%, if banks are willing to give you and lend you money at 3.5%, and if it's for a mortgage,
decades,
yeah, for 3 decades,
right,
and the interest you pay, the government gives you a deduction for it, so it's not even 3.5%.
Right.
And I mean, it doesn't. The house doesn't even have to go up.
I'd mic drop this, but this is a really nice microphone.
Yeah, and we've experienced that.
Oh yeah, we did that with one, didn't we?
Yeah. So the negative to a positive is that owning a home is preventing you from being in a situation that your rent is keep going up because of inflation. Now, inflation is very low right now, but rents are going up faster than inflation. So not being a victim of that type of a market. And when it becomes a factor, so there's 2 factors that are coming into play that concern me for renters, is that we have a slow growth economy. And so you have a contraction of per square footage living per capita.
Right.
So people are using less square footage right now, and that's why you have this discrepancy of ownership to new construction, because people are living either together or living in smaller spaces. But that's because we have a slow economy. When things start turning around, they're not going to want to live with their friends. They're not going to want to live with their parents. They want to want to buy something, and lo and behold, there's not enough homes.
Right.
And so if there's not enough homes, rents are going to go up. And rents, you're a victim of rising rents, or you can be outside of that potential risk and know you got yourself locked in. You're not going to be subject to the tenant going, by the way, rents just went up 10%. A side story, when we moved from North Bay, north of San Francisco, to South Bay, which is Silicon Valley and that whole technology area, which was fantastic.
In 1999.
Yeah. We rented a house that was smaller than the house that we had in North Bay and was worth 3 times. It was not worth. It was selling or valued 3 times the home that we had in North Bay. And so we rented that home, and I think it was $2,300 a month, which was...
For that house?
Yeah, for that house. So it was a 6 months rent.
I like that
So
house.
we rented it...
It was a weird house.
December. Okay, so right at Christmas, remember that we had Christmas, and then
I don't remember.
Yeah, so we had a full. Cynthia said, "I want a full Christmas tree, lights, decoration, everything." Okay, and then on the 26th, we started tearing everything down, and we moved, and we had to be in the new home by January 1st. But anyways, at the end of 6 months,
this is when we moved from Rainbow to Miller.
No,
we were at Rainbow first.
Yes, right. But when we moved from Petaluma to Rainbow.
Okay.
But anyways, so at the
I
end
like
of
that
6...
house. I take it back.
Yeah, so that was
Miller
a nice
I
house.
did not like.
No, Miller was goofy with house. But anyways, at the end of 6 months, right? So this is June. The landlord said, your rent's going to $2,800.
I remember that.
$600, almost a 30% increase. I said, you're crazy.
Nothing has changed.
Yeah.
In 6 months.
So he looked at me with a blank stare and said, are you moving out or are you paying the $2,800? I go, you can't raise the rent 30%. There was a line waiting to rent that house for $2,800.
And it was on the corner across the street from one of the most competitive academic high schools in the country.
Which we didn't know that until we got it. But imagine you're looking for a raise, right? You get a 5% raise, and then your landlord says your rent just went up 30%. I mean, that's killer.
Right.
Right.
It counterbalances each other out.
And that same home today is $4,500 a month, right? So the point is that don't be complacent that you have low interest rates, low inflation, and you think, oh, I'm fine. I like where I live. I'm paying my rent.
Right. I'm cozy right now.
I'm fine.
I'm making more. Inflation's low. Gas prices are low.
Yeah, why do I want to buy a house?
Cost of goods is low.
Cut the lawn.
Right.
When you get the landlord calling you up and say, hey, 30% raise or get out because I can get that.
What happens? Yeah, exactly. When the economy turns around, everybody's making more money.
Right.
Everybody's buying.
Yeah.
And now you can only buy what people are selling.
Right.
The people who are selling are the ones who bought now.
Right.
And they're making the money.
Right.
And you're getting in at the high.
Right.
Because everybody else is buying because of that curve that we talked about with the emotion.
Right. So to summarize all of this, just like the saying that we talk about, when's the best time to plant a tree? And that was 20 years ago. Second best time to plant a tree is today.
Right now.
And so there's lots of reasons to wait buying a home.
I'm going to go plant a tree.
Yeah, you should do that. We did.
You're inspiring me.
Yeah, we've planted lots of trees.
What'd you plant?
We have some nice Japanese maples that we planted.
Okay.
That are now 10 years old, and they're beautiful. But anyways,
sorry.
Yeah.
That one that opened up.
Yeah. So there's lots of reasons to wait buying a home, and there are key market peaks. And 2005 to 2010 was a clear market peak. We were actually selling in 2005, not buying. But after a big crash like 2005, and market cycles in real estate is about every 25 years. So we're clearly, the best time to buy is after a crash, not a time to get conservative and go, man, look what just happened 4 years ago. I don't want to be vulnerable to that. When market cycles going back to the 1800s in real estate are about 25 years apart. Now, that doesn't mean there's going to be a market crash.
Which is great to look back upon. Hard to read. It's a great previous, hindsight bias type of thing. Looking forward, it's hard to predict. But it's there. It's consistent regardless. And I'm even just not smart enough to understand that stuff.
Yeah. But even still, our house went below not quite, but below what we bought it for in 2000. We bought our home in 2005, right? So we moved for lots of reasons, not for real estate investing, but it was below at certain points than what we bought it for. I don't care. I liked my house. I'm just going to keep paying the mortgage. It doesn't really mean anything. Now, the wealth effect, which we talked about, it had a little bit of an impact, but still, it didn't change my ability to go out to dinner or anything. And so, for the most part, if you bought a home at the worst time and it goes down, but you can still make the payments, who cares?
Very intriguing stuff.
Yeah.
I'm glad that we had this conversation. We'll expand on it more.
Sure.
You particularly have written some amazing blog posts. If you go to our website, financialtimetraveler.com, you click the real estate bubble.
And then you made it grammatically correct.
I didn't write that, okay? I'm not going to take responsibility for another man's mistakes.
Okay.
But you go to financialtimetraveler.com, you click real estate. It's going to take you to the splash page that shows all the real estate posts. Anton has done a few very detailed, couple thousand words detailing exactly why you should buy, how you should buy, the process of building a real estate portfolio.
Do I get paid?
Very powerful stuff. We're going to make money eventually. We're on the jab, right hook scheme.
All right.
But we appreciate you guys going and visiting. If you'd like more, shoot us an email, shoot us a tweet, give us a Facebook comment, all that. We'll respond to you. If you have any questions, we'd love to cover it on future podcasts. Otherwise, we appreciate you coming. We'll see you up next on episode 8. We're getting close to double digits.
Yeah, 8.
I'm proud of you.
Right.
All right, guys. See you later. Decisions today, change tomorrow.
There you go. There you go.